management. And we'll go over how you define those, and then setting up an investor profile. This includes the investment objectives, risk profile, and time horizon. Once we've set those, we can kind of determine our asset allocation, and then how do we go about monitoring and reviewing, and then some additional considerations that you can or might want to include in your investment policy statement. And then we'll just kind of summarize everything from today. So I will likely also refer to an investment policy statement as an IPS. So if you hear that pop up throughout the presentation today, you'll know what I'm referring to. I should also disclose that if you work within CASA, we are an advisory role as opposed to a discretionary investment fund manager. And the difference between the two is that, an advisory role works with the investor, provides some recommendations based on, your risk profile, your investor profile. We would have answered sort of a series of questions to determine what's suitable types of investments for yourself specifically. And then all the investment decisions come from the investor. Whereas in a discretionary role, the investor kind of turns over the reins to the advisor and allows them the ability, once they've set those investor profile matrix, to kind of then manage it in the background. So they have the authorization or ability to do some discretionary selling or trading, adjusting asset allocations within set parameters, and that's not something we do. So when you engage with an advisor in a discretionary role, you will most certainly have an investment policy statement in place that would be signed by both the advisor and the investor, and then the advisor can take it from there. When I'm referring to investment policy statements here, this is typically something that you would keep at the board level. So this would be an internal policy that you've established that you would share with new board members, any committees you have established, management of the nonprofit, as well as any external consultants that you might engage with. So I'll just move on to myself here. I've been with CASA over 4 years now. I come with 12 plus years of financial services experience, hold a BBA in entrepreneurial leadership, as well as registered with the MFDA as a dealing representative. Our back-end dealer is WorldSource Financial Management. I do hold my certified financial planner certification, and within CASA, we solely deal with affordable housing providers. So our 800 plus investors are all within the housing sector. So we really do have a deep understanding of some of the challenges that you face as housing providers when it comes to investing, and just some of those challenges you face in general. Being strongly involved in the sector, sponsoring many of the events that you attend, as well as our ownership structure, kind of keeps us front and center within the affordable housing sector. So we'll move forward here, and I'll just play a quick video that summarizes sort of in CASA who we are and what it is we do.
CASA Financial is a social purpose investment fund manager with a long-standing commitment to responsible investing. For the past 20 years, the community housing sector has entrusted us to invest their capital reserves, deposits, member shares, and surpluses. We are pleased to now be managing over $550 million of housing providers' assets. Owned by 4 of the leading housing organizations across Canada, and CASA provides customized, low-cost, responsible investment solutions with access to professional money management and advice from individuals who hold deep-rooted expertise in the affordable housing and investment industry. For the many housing organizations who invest within CASA, it means greater economic security by meeting their future financial needs. They also know that their investments help create benefits to all communities through the responsible investment policies that govern the fund.
I was speaking with one of our co-op investors recently who was able to build a community playground with their investment earnings. And for the past 2 years, they've opted to use their gains from their portfolio to offset operating budget increases and maintain the current housing charges for members, all of which was possible by investing part of their existing assets within CASA Financial.
One of the things that sets us apart is our knowledge, experience, and understanding of housing providers' operations, being able to tie that into customized investment strategies. We understand the intricacies of the operating budget, building condition assessment, capital plan, and funding uncertainty, and are able to develop a plan that is fluid and suitable for each housing provider's unique circumstances.
For our investors, knowing how their money is invested is important. They want to ensure that their investments are aligned with their organization's overall mission and values. And CASA's responsible investment policy provides this assurance by investing in companies that conduct themselves in a socially responsible manner, meaning their business practices favor the environment, promote workers' rights, and demonstrate strong governance.
Ensure your organization's financial sustainability today and come join more than 800 other fellow housing provider investors. For more information, contact us today.
Perfect. Okay, so that kind of, I'm sure you've heard about Incasa before, but if you do have any further questions or your board is interested in having a presentation, certainly don't hesitate to reach out to myself or any members of the team, and we can look at getting in contact with you. So, what are the board's responsibilities? Well, the board certainly has a fiduciary duty, and that's to manage and are responsible for the assets of the nonprofit that they oversee. So this would include any capital assets, the building, the land, any vehicles, equipment, any of those sorts of things, as well as the investable assets. So any funds that you might have set aside, capital reserves, certainly in the case of co-ops, there can be member shares. There's damage deposits, all these, the operating account, all these funds need to be managed. And the board does have a fiduciary duty to oversee these, whether they delegate those responsibilities or not, they still have an obligation to ensure that they're checking in on the status of those assets and how they're performing and if they're doing what they're intended to be done. So the investable assets, there's also a fiduciary duty to invest those as a prudent person would. So meaning that you've gone through the due diligence of what a standard person would do when it comes to investing. So that's why I always say this investment policy statement is kind of the best cover your butt tool as a board, which are often, voluntary boards. They all come with different, probably personal investment preferences. So it's best to put this in place. It gives a more holistic view. Your board can take a step back and sort of eliminate any of those individual investor biases they might have, and look at it from the lens of, these are the nonprofit's assets. We are investing these, assuming the nonprofit's going to operate in perpetuity, and we're tying this to any financial obligations that we'll have along those lines. So by doing all this, it shows that the board is fulfilling its fiduciary duty, and then we always recommend too, because not all boards have a level of investment knowledge that they might require to make these investment decisions. So when appropriate, always, seek external consultation, whether it's an investment fund advisor, consultant, your banking representative, someone within the industry that has typically more present day knowledge of what goes into these investments. It becomes very onerous on the board and or management when they try and manage these investments on their own. We find, if you're several GICs, they all have different maturity dates. Do we lock them in? Do we go for cashable? Are we just leaving it in a savings account? Are we trying to set up a self-directed investment account and then making security selections or, fund or ETF selections from there? It becomes very cumbersome for a board that, might just meet quarterly and or management that's trying to oversee this on a regular basis with monthly reporting and whatnot. So what's the purpose of an IPS? Well, this description here kind of summarizes it all up very well, but the purpose of an investment policy is to provide a prudent framework for the management of the organization's investment portfolio. It identifies the investment objectives, risk profile, and time horizon, defines the responsibilities of any other parties involved in managing the investments, and it's there to provide target asset allocations, permissible investments, diversification requirements, and it also establishes standards for reporting, monitoring, and reviewing the investment portfolio. That's just sort of an example of a purpose that you could put at the beginning of your IPS, and it does a good job of capturing everything that a good IPS would include. So, we kind of just talked about it in that last description, but it would define the purpose, objectives, provisions, and guidelines for your portfolio. You can have multiple IPSs, or you can have one overarching IPS that includes sort of several different investable assets, whether they be short and longer term, capital reserves versus damage deposits, etc. So it'll go through and delegate responsibilities as well, which we'll cover coming up here shortly. And it'll summarize the investment strategy, and then again highlights the process for reviewing, monitoring, and reporting. So I've seen all types of IPSs, some lengthy, some very short and succinct. So it's really up to the board and or management as to how elaborate they want to get with their IPS. Some can be pages and in great detail, and others, can be shown on one or two pages. So, my preference as an advisor is a shorter, more succinct one. Depending on what type of advisor you're engaging with, they might have different abilities to include certain security selections, whether they just operate within funds, or if they go out and buy individual bonds or securities. So if you get too specific in your IPS, it doesn't always align with what the advisor is able and or willing to do in terms of the investment process. So, you want to have those provisions in place, but you also don't want to run into issues of, well, you've put these parameters in place and this fund that, we're looking to invest in doesn't necessarily isn't suitable based on those restrictions. So, it kind of limits the advisor's ability to do what they would normally do. So it is a fluid process, and I do say work with your advisor as you're going through this. Like I said, in the initial planning stages, this is where we'll often run into, well, we don't have an IPS. So then the board goes away and it's another 3 to 6 months just for them to develop one. So I do have a couple of samples that I often send out to any investors that we're dealing with that's looking to establish one. And it just provides some good, pick and play tools that you can sort of input to make an IPS of your own. But these are sort of some of the general topics and or headings that you'll see. And it doesn't have to, break them down into each. You can just sort of go with the main bullet points and probably cover all those subsections within there without, having to list them on multiple pages. But those would be some of the headings that you would see on an IPS. Whether with a table of contents or just going through kind of a 2-pager type thing. So mentioned earlier, roles and responsibilities. So with the board, likely volunteer board, you might have some past experience with some board members that might have been within banking or finance or even investment advisors themselves. Often there's some accounting backgrounds as well. So there is typically some, particularly on nonprofit boards, some level of investment knowledge there. So with that, they might look to establish possibly a finance or investment committee, sort of subcommittee within the board of those, maybe 2 or 3, 4 people that do have a greater investment knowledge basis to work off of than maybe some of the other board members. And that just sort of alleviates the board of maybe 8 down to sort of 3 or 4 people making the investment decisions. Not necessarily the decisions, but the recommendations. So they would go off and do the work like setting up an investment policy statement. It would then be communicated back up to the board as a whole, and obviously they would vote to approve it and whatnot. But the board has the ability to delegate sort of the investing responsibilities to a subcommittee of their choosing. I've also seen boards that look to delegate to management. So, they might have a CFO as well as their executive director or CEO that is willing to sort of take on either setting up a policy or under the directives of the board, going out and seeking those suitable investments that the board is looking to participate in. So I've seen it sort of 2 ways. Usually when we're setting up accounts, what we'll see is very similar to the banking structure. So often they'll have, let's say there's 8 board members, president, VP, treasurer, and secretary will typically be the 4 that go on as signing officers. And then most accounts are 2 to sign. So ultimately, if there is movement in or out of, let's say, the capital reserves investment account, it does require signing off from at least 2 board members. Otherwise, they can include management as well, just for ease and facilitation purposes. Management's there day in and day out, and then you might include sort of the president signing off as well, in addition to management. So you're not limited as to who you can put on the account, but just understand there is the paperwork process and the verifying ID process of doing all that as well. Very important if and when setting up a committee that the board looks to set parameters for reporting back up to the board. Remember, they retain the ultimate responsibility of that fiduciary duty. So they need to know what's going on. And it's fine to have a committee to oversee this, but the board can't be left in the dark as to then what's going on in those committee meetings. So setting up the frequency at which the board is reported to, and what specific authorizations that the committee would have. You can also look to include within the IPS the authorization to seek outside expertise, whether this be investment manager, consultant, or like I mentioned, banking representative. You should state it in the IPS that the board and or committee has the ability to go seek additional expertise. So then we'll get into sort of the investment objectives or the investor profile of the IPS. And this seeks to just determine whether we're looking for growth objectives or more capital preservation or sort of a mix in between. So when I say growth objectives, I mean, you know, typically equities are your growth objective investments that you would include there. And when we look at capital preservation, we look at, you know, GICs and or bonds. And then, you know, an investment objective or profile will likely include a combination of the two. So you'll typically see the percentages where each would fall on either side of the growth or preservation side of the fence. When we're setting up our objectives, you should seek to at least maintain your purchasing power. This can become challenging these days with inflation at, you know, anywhere between 5 and sort of 8%, which wasn't, you know, a standard. That's maybe what you would look to achieve for your investing. But that was always, you know, well and above standard inflation, historically around 2%. So now, you know, you're forced to sort of theoretically take on a little more risk to ideally achieve some higher investment returns, simply to just keep pace with this inflation. Now, you know, I don't think anyone really expects high inflation to persist longer than sort of the short term that we're experiencing it in now. So, you know, we should and will see it subside at some point. So I wouldn't necessarily make your investment decisions based on current inflation percentages. You know, it's probably still safe to assume the 2 to sort of 3% range is what it'll theoretically be moving forward within sort of a year or two here. One part that's often overlooked is considering the time horizon. So boards tend to be inherently conservative with their investment profiles. I don't know an exact reason for this. Sort of the best reasons I can come up with is it's a volunteer board. They don't want to be overly risky with the nonprofit's assets, and or you know, no one really wants to be the one to say, hey, you know, we should invest in this, and then all of a sudden the market corrects, and then everyone looks at that person and says, hey, you know, why'd you tell us to do that? We've lost money now. So I think there's some sort of apprehension, but again, if you're doing that due diligent, prudent person process, no one can really fault the investment decisions that are made at the end of that process, because you've gone through and considered what is our risk profile, what is our time horizon, what investment objectives are we comfortable with here. And I don't think, you know, anyone's going out and going, let's buy GameStop or invest it all in crypto and these types of you know, overly risky investable assets. I think for the most part, boards would make sound decision when setting up their allocations. But they do tend to sell themselves short by thinking their time horizon is much shorter than what they actually have. And make sure the objectives align with your risk profile. So it might be one thing to say, well, we want a target rate of return of 8%, but we don't want to take on any risk, where we're 100% capital preservation. Those two things don't align, right? So you can't, you know, have super high returns and take on no risk. There has to be some sort of happy medium there. So your target rate of return should match the allocation objectives. So how do you determine your risk profile? Well, the regulators have expanded this actually as of recently. We used to just look at risk tolerance, and that's basically what's your willingness to take on risk. Whereas now sort of they look to create or for the advisor to determine a suitable risk profile. And this looks at not only risk tolerance, which is your willingness or the board's willingness to take on risk, but also your risk capacity. So what is your ability to take on risk? So, and it's always sort of the least risky of the two that will prevail. So when we say capacity, we kind of rely more on what fallback do you have should there be a market correction and you have to hold off drawing on your funds, or what if you were to lose 100% of these funds you're looking to invest? What other resources do you have to fall back on in that event? So typically we'll see establishing your net worth, so taking into consideration all your fixed and liquid assets, less any liabilities that you would have, determines your net worth. And then we can look at annual revenues. So sort of what are you taking in from market rents? What are you getting in grants or subsidies or additional funding? And then what are your annual operational costs as well? These tend to sort of break even for the most part. But you're looking at, do we have access to additional funding in the event that we would need it? Do we have the ability to borrow in the event that we need it? What are some other options? Do we have the ability to raise rents? Do we have the ability to go out and fundraise? Do we maybe have a suite or a portfolio of properties that we manage? And, would we have the ability to sell one of those in the event that there was a shortfall we needed to make up with it on the other assets? These are all various considerations that you can look at. What's your capacity or fallback? And then, really think about when you're going to need these funds. So often what I'll run into is we'll see a provider that has multiple properties. They have multiple building condition assessments on these properties. They're all built in different years and are in different states of repair or disrepair. And you might have, let's say, a pool collectively amongst those 5 or 6 properties, of $1 million in reserves. When you look at your building condition assessments and what your sort of next major projects for each of those buildings are, you're likely adding up to a number that probably exceeds your reserves. Then we'll often run into this scenario, but the reality is you're probably not doing all of those major improvements all within the timeline that is stated on the building condition assessment. In many cases, they're just put on there on the timeline because that's the expected life that's the life expectancy of that capital component. So, a brand new boiler will last 15 years for, let's say. So on a new build, a new build from 2020, they'll go 2035, you need a new boiler. That might not be the case. It could last 12 years, it could last 20 years. If there's been ongoing maintenance, you're probably going to prolong the life expectancy of those capital components. So you're not necessarily going to have to do them right when they say they need to be done in your building condition assessment. The other reality is that you're probably not undertaking all those projects on all those properties all, at the same time or within the same year. So you'll probably stagger them out, especially if they're more major projects, and you'll look to maybe bundle or unbundle some of those projects. So if you're doing, let's say, the carpets in the common area, but then you need to paint it the next year, and you also need to replace the interior doors the following year, as well as maybe there's some plumbing upgrades or something. But if it's focused within the common area, it would make sense to bundle that. So you're not going to do a project once each year within those 3 years. It's probably best to bundle that up, do it one shot, interrupt the tenants less, and probably have some better economies of scale by getting the contractors all in there at once. You know, when the carpet's up, it's easier to paint, also easier to change the doors, all these types of things. So it will typically lower your overall cost by bundling projects like that. So you really got to go through your building condition assessment, the fine tooth comb, and either apply what's realistic or unrealistic. And then from there, going back to the multiple property example, we could say, okay, well, our next major expense is 200,000 of that million. Let's ensure that these funds are sort of set aside in a safer pool, and let's let the rest of the capital reserves grow and give it a bit more of a longer time horizon. As we go through and complete that upcoming project, you know, we might get lucky and actually receive the funding from BC Housing to either fund that project either in full or partially. So we might not even need to spend the money that we had anticipated spending. So that again extends our time horizon. In the event that we don't receive funding, we do spend those funds, then we just look at what's the next big major capital expense. Oh, it's going to be $175,000 the following year. Okay, well, let's look to establish that kind of safety net or pool of the next major expense. So that one's there sitting in the wayside when we need it in a year or two. And again, we'll allow the rest to continue to grow. So this is all considerations that you need to factor in when determining your risk profile. So we'll often see, again, boards under risk their portfolios, and they do this because they're conservative in nature, or they're, you know, going hard and fast off the time horizons that they see in the building condition assessments, or they're just fearful that, you know, when they look at things, they go, well, we don't even have enough money to complete everything we need to do to begin with. So we're not going to actually risk any of these funds to try and grow them at a decent pace because we're going to need them in the near future. So if the reality is you're going to need them all within a year, you know, I wouldn't necessarily recommend investing in the markets. You'd probably look to a savings account or a GIC, but you really have to say, is the reality that we are going to need all these, or will there be funding coming in, or will some of these projects get pushed out? How we've been doing ongoing maintenance. All of these examples that I just sort of gave are reasons that, you know, you likely won't need all those funds when you think you're going to need them. So time horizon, I mean, we just covered a lot of this as well. But, you know, what I often see, a couple of highlights here, is that when we say, what is your time horizon, or when we'll need a significant portion of the funds, it's usually, you know, when we're going to need sort of 30% or more of the capital reserves. And if that's 3 or 4 years from now, your time horizon would be 3 or 4 years. But we also have to make sure we're factoring in what's the anticipated rate of return over those 3 or 4 years. So what, you know, level market value will we be at then? And does the redemption still exceed that 30% threshold? And also, what additional contributions are we making along those years? So if we're setting aside $75,000 a year to our capital reserves, you have to take that into consideration, that we're growing that asset base as well. So, you know, in 4 years' time, you're going to have an additional 300,000 on top of, let's say, your 400,000 you already have set aside. So, you know, your $150,000 project, does it now exceed 30% of your, let's say, 700,000 you have invested? So, you know, that's what we're here to do, help you work through all those kind of questions that either an investment committee and or a board might not consider or think to consider. These are some of just the investment decisions that we run into on a regular basis. So, you know, we see it day in and day out. And I might mention something to you that you might not had even thought of. And I love working with executive directors because they provide a whole different perspective of the challenges that they deal with day in and day out. And just from having conversations with them, we can then determine, a suitable portfolio that'll work for each of those unique housing providers. So now that we know sort of what our risk profile is, investment objectives, and what a time horizon is, this is a sort of a good illustration of what a basic asset allocation model looks like. And these are just sort of your standard industry asset allocation percentage ranges. So as you can see, the lower the risk profile, the more focused on income the investment objectives is, or capital preservation, and the shorter the time horizon, you're going to be lower in your risk profile. So you'll look to invest more in bonds or fixed income versus equities, because you don't necessarily have that time or willingness and or capacity to take on any of the increased volatility that you would experience by greater exposure to equities. Highly conservative boards can still get by with, I would say these days, probably like a 70% income allocation with a 30% asset equities allocation. I certainly recommend, even if you're overly conservative, having at least a 10% equity exposure, simply because we're not seeing it so much this year, as both asset classes are down across the board, but typically they'll work against one another. So when equity markets are up, bonds are typically lagging, and vice versa. When equity markets are down, bonds are usually what helps support or bolster up the portfolio. So you want to at least have some component of diversification, just to help offset any, you are really taking on. Boards might think they're being overly conservative and sticking to one safe sort of bond or fixed income asset class. But in reality, they're probably taking on more risk by having all their eggs in one basket. So, just because there's lower volatility with bonds doesn't mean there's no risk with bonds. And certainly you're increasing your risk by not having some counter exposure there incorporated as well. So how do you go about determining this asset allocation? Well, like I said, it's a mix between equities and bonds. You want to factor in the objectives and risk profile and time horizon, set the target ranges for your asset classes. So you might say, well, we are anywhere from 50 to 70% fixed income, and anywhere from 50 to sort of 30% equities. And that allows some ability to move within those ranges. Again, you want to factor in your capital plan, your building condition assessment, what your future cash flow and liquidity requirements are. And this is super helpful when you bring in that outside expertise to help determine what the suitable allocation would be. So I think it's just reaffirming the need to seek outside counsel. I often find you sort of get within a bubble of your board, and it just is a fresh take to have that outsider's perspective. Like I said, I deal with 800 different housing providers. They've all gone through different but also similar things. I might have some suggestions or tools, or what other housing providers have done in your similar circumstance. So it's a free consult. Use those resources when they're available, right? So and then getting on to, once you've established all those parameters, another important and often overlooked area is the monitoring, reviewing, and reporting. So you'll likely get quarterly statements from your advisor or investment fund manager, in addition to your annual statements. It's usually good to, boards typically meet quarterly, at least establish a reporting frequency of a quarterly. So you'll just look at what the market values are, if there's been any dramatic changes in those, what are sort of the benchmarks or the market as a whole doing during that period. Have we made any major contributions or redemptions for some capital improvements that we're doing? And it's the board's responsibility to ensure they're monitoring this. I know there's a lot that goes on meetings and you're quickly trying to shuffle through things. And it's usually just, okay, have we reviewed the investment statements? Are we okay with where the market values are? Any questions or concerns with that? Everyone just goes, yeah, okay, approved motion, move forward, right? So, we're happy to come out and speak at the board meetings, whether it be virtually or in person, and just provide a quick macro market update, right? And if the portfolio is down 5% on the quarter, it's good to get some context as to why. Is that unique to our portfolio, or is there overarching macroeconomic markets that are coming into play here? So, if you're keeping in line with the benchmark, typically your portfolio is doing what it's supposed to do. That being said, you also want to ensure that you're defining your performance objectives. So, we've set that target rate of return. Is it realistic with the investment objectives that we've set? Are we evaluating the return net of fees incurred? Are we basing it based on the benchmark? So setting these evaluation metrics is important as well, because it's fine to say, well, we're going to review things quarterly, but then you don't have any evaluation criteria that you're actually reviewing. So that's where I think you run into that issue of, everything okay with it? Yeah, good. Okay, move on, next thing. But if we have those criteria in place, then we can say, well, we're actually a little shy this quarter, or hey, great, we're exceeding our target. So, and then establishing an annual review process, right? So this will typically be, myself meeting with the committee and or the management and or the board as a whole, and then them going and reporting to the board. Often when I cover in the meetings, I don't necessarily expect those representatives to then go back, particularly if maybe it's just a property manager that I'm conversing with as well, to go back and then regurgitate everything that we've discussed to the board. So that's why I always offer, our time to show up and go through these things if the board would see some value in hearing it from there too. Others, just want to know where the numbers are at and they can see it on paper and it's all good. They can take it from there. So really up to each their own to set sort of how frequently and how involved they want to have that review process. So a couple of additional considerations that you can include in your IPS. You can mention the tax exempt status as a nonprofit, charity, society, co-op. You do have this luxury of not having to pay tax on any of your investment gains earned. I also like to include, and it helps provide some perspective and sort of just recenter the board in their thought process of the expectation that we're overseeing this assets of the nonprofit. It's not coming from an individual perspective, and this nonprofit is expected to operate in perpetuity. So it really helps stretch that time horizon and thought process when making those investment decisions. You can also set some authorization for approvals and who can sign off on any redemptions or contributions. It might be limited to sort of 2 or 3 people, or it might be sort of the signing officers on the account, or sort of what is that sequence of when we do need to make a purchase or redemption, who has the authority to sort of approve those. And then also restricting the use of gains and or borrowing for the investments. Always good to just highlight that in there as well. And then in particular too, if you want to exclude any specific securities or investable asset or investable products. So, you know, do we want to shy away from nuclear or tobacco or alcohol? Or is there something that, you know, really just doesn't sit well with the specific mission of our nonprofit? You know, you can say what you will and will not allow in your investment portfolio. Those are some general additional provisions that you can include in the IPS. You can create a whole section on responsible investing too, if you want. And we find that always aligns very well with nonprofit missions, values, and goals as well. So we've kind of described what the purpose of the investment policy is. We've defined what the responsibilities of those either committees, authorization, you know, who has what delegated responsibilities. We've gone through what the investor profile looks like, how we establish those objectives, setting the asset allocations once we've determined that investor profile. And then how do we go about monitoring and reviewing our investments once we've established them? So, you know, by putting an IPS in place, we ensure that we remove the emotional element associated with investing. So what we see often is, well, markets are down. You hear all this noise constantly coming in. Inflation's up and unemployment numbers are up. Bank of Canada is raising the rates. Oil's up again. Canadian dollar's down. War in Russia, you know, is still ongoing. All these different things that we hear in the news daily that strike fear to our investment strategy, right? And we begin to make knee-jerk, short-term, emotional investment decisions based on what we're hearing. When in reality, we have long time horizons. Noise is going to go on regardless. Do we have the ability to tolerate any fluctuations that we might see in the market? And if there's been no material changes to your nonprofit position, then there's really no reason to make any emotional investment decisions. So yes, it might be tough, as for example, this year that we're going through now. You know, most of our portfolios are down. The markets as a whole are down. So it's not just your ship that's sinking. It's sort of everyone involved that's riding this roller coaster of a wave. So, you know, are we within the benchmarks? Does everything still make sense? Do we still have some time on our side? All these things lead to a yes answer. Then we're probably safe to stay the course. And if we're doing this, then we're reconfirming the board's commitment to fulfilling their fiduciary duty and trying to help the nonprofit establish its goals. And with that, sort of, I'll look to wrap it up. If there's any questions, happy to go through some discussion. You know, I might not be able to get into specific details related to your nonprofit if it comes to specific investment questions, but I can provide some sort of general answers as to what we'll sort of see with people in similar situations. It's my contact information here. Work out of the Housing Central office on Commercial and First. So you can always shoot me an email, give me a quick call if you want to discuss anything in further detail or look to some additional information I can send over for board review or whatnot. But I encourage you to get that sort of initial conversation started at the board level. And if you don't have an investment policy in place, look to get started on one. I did mention I have a couple of examples happy to share with you to give you those tools that you need to get going with it. So Jim, sort of, I hadn't been following, but feel free to jump in with any questions that we might have.
Thank you so much, Mike. So one question we did have is whether this PowerPoint presentation could be available for the participants. BCMPHA could email that out to the participants if you could make it available to us.
Yeah, absolutely. I can get it as a PDF and provide it to you, and you can send it out to whoever's interested for sure.
That works great. And so there was another question as well that came over the chat. How does Incasa make its money? Is this through fees or a percentage of investments?
Yeah, so we're a little different than most advisory firms in the sense that sort of your all-in cost with Incasa, and it was sort of our mission and objective to provide responsible investing, professional money management to all housing providers at sort of the lowest cost that we can. So we're not fee-based. There's no initial sales commissions, there's no back-end sales commissions, there's no deferred sales charges, there's no annual trustee fees. The only costs that you'll incur investing within Incasa are what's called the management expense ratios on all three of the funds that we actually offer. So those range anywhere from 0.8 to 1.12% currently. So we're a standard portfolio that has a mix of all three funds. We'll typically see the cost, the all-in costs incurred at around 1%. So your returns are always shown net of fees, meaning you see 5% on your statement at the end of the year. In reality, the portfolio did 6%. The 1% MER or management expense ratio was incurred to get that return. That's charged at the fund level, so it's proportionate to your investments that you hold in each of the funds. And the net result is the 5% return on your portfolio.
Thanks, Mike.
But other than that, there's no additional charges, and we're not fee-based or fee for service. So, you know, happy to meet and work with you. And if it ends up being a suitable fit at the end, great. If it doesn't, hopefully you've gained some additional knowledge that you can take forth in your investment pursuit. So.
Sure. And there was another question. Does Incasa provide services to not-for-profit employees? Whoever provided that question, feel free to jump in, but I think this might look like professional development resources potentially.
Yeah, I mean, if that's what we're referring to, sort of like, you know, sessions, education sessions, we certainly can look at doing something along those lines. But in terms of investing in Incasa's funds, we are, you know, basically closed to retail investors or individual investors. It's effectively, you've got to be a corporation or a nonprofit, and sort of be an entity that for us to be, or for you to be able to invest with us.
Sure. And Mike, I have a question. Just knowing the sector and the diversity of members, especially, you know, the size of members. We have some nonprofit housing providers that might have just one small portfolio, and then others that have multiple buildings. I'm just wondering if you think there's a threshold at which societies or housing providers should consider an investment strategy, either in terms of amount of reserve, or do you think this is something that all organizations should probably think about?
I think it's important to have, like I said, it's a great cover your butt tool. You never know. You know, I think there's some increased focus certainly on the sector right now in terms of you know, our funds being managed properly. So it certainly doesn't hurt to have an investment policy in place, because if anyone comes knocking, you can sort of say or show, look, we've gone through the process. Here's sort of the parameters that we've established. We've done our due diligence, and you know, we're working within what, you know, a reasonable investor would seek to do in this situation. So, you know, regardless of size, I would say it's important to have. The larger you might get, the more sophisticated your IPS might become, particularly if you're looking to manage multiple properties and they might have different needs. So you might have to start segmenting and have different sort of sections of the IPS that apply to different target allocations. But in general, we'll probably see like a decent IPS can sort of blanket and overarch, any investable assets that you might have, especially if you're just sort of disclosing short-term investable funds versus longer term. But definitely, there's, I believe BCNPHA has a template for one. We've got a couple samples as well. I think there's a few others kicking around, but certainly use those tools and at least get something on paper, because like I said, it just shows that you've gone through that process and taken the steps necessary.
Sure. Thank you, Mike. So we are just closing in on our end time, and I'm just wondering if there's any other questions from participants. This isn't a big group, so feel free to just turn off your mic if you have a question for Mike. Okay. Well, seeing no other questions, I think we might wrap up. Thank you all again for the time. Thank you, Mike, so much for this valuable presentation. We will send out that presentation a little later this week from Mike, and thank you all so much for participating. I sent the link on the chat for a session evaluation. If you have some time to do that, that would be really helpful for us as we develop new educational programs for the membership. Any final thoughts, Mike?
No, just thanks all for attending. I hope it provided at least some sort of value to you, particularly if you're thinking about going through this process. We wanted to highlight it because it seems to be a challenge that we're running into quite frequently when we're going through the investment planning process. So don't be shy. If you have any quick questions particular to your specific nonprofit, shoot me an email, give me a call, and we can work things through with you. And again, I've got those additional resources if needed. And Jim will get you a copy of the presentation, and we can circulate that as well. So.
All right. Wonderful. Well, happy holidays, everyone.
Yes.
Enjoy the rest of the year. Bye-bye.
All right. Thank you. Take care.